Why does the stock market crash when inflation rises? Why does a small decision by the central bank suddenly make investors rich or broke? Here's the truth: the stock market isn't just about buying and selling shares. It's deeply connected to the economy itself. In next few minutes, I'll show you how the stock market really works. Not from a trader's view but from an economist's lens. And once you understand this, market ups and downs will finally make sense. Today in this video we will see some concept of stock market. First, let's keep it super simple. What is stock market? The stock market is basically a place where companies raise money by selling tiny pieces of their ownership called shares to people like you and me. If the company does well, the value of those shares usually goes up. If it struggles, the value drops. But here's the twist: a company's performance is shaped by the economy. And that's why stock markets rise and falls based on economic changes. The economic forces behind stock market. Let's break down the biggest economic factors that drive the stock market. GDP, the economy's report card. When the country's GDP, the total value of goods and services, grows, companies usually earn more, people spend more, and investors expect higher profits. Result: stock prices climb. But when GDP slows, growth fears pull the market down. Inflation, the silent profit killer. A little inflation is healthy. But when prices rise too fast, companies face higher costs and profits shrink. Also, central banks respond by raising interest rates, and that slows down borrowing, business expansion, and ultimately, stock growth. Interest rates, the hidden lever. Low interest rates equals cheap loans equals business grows equals stock prices rise. High interest rates equals expensive loans equals growth slows equals stock prices fall. That's why one small announcement from the Reserve Bank can shake the entire market. Government policies, the economy's steering wheel. Tax cuts, infrastructure spending, subsidies equals all these boost economic activity and often push markets up. But heavy taxes, sudden policy changes, or budget cuts can trigger market fear. Global events, the wild card. Wars, oil prices, pandemics, trade wars, global shocks instantly affect supply chain, demand and confidence. And the stock market reacts within minutes, even if the event is happening on the other side of the world. Expectations matter more than reality. Here's something most beginners miss. Stock markets don't move only on today's data. They move on what people expect will happen tomorrow. If investors believe the economy will grow next year, market often rise today. If they fear a slowdown, prices drop even before anything bad happens. It's all about expectations. Now the next time you hear about rising inflation, a new budget, or an interest rate cut, know this: it's not just boring economic news. It's a direct signal for how the stock market might move. Because the stock market is not a casino. It's a reflection of how people believe the economy will perform. If you understand the economy, you understand the stock market, and now, you're already ahead of most beginners. If you want to see more videos like this, please comment.